we're going to be looking at a couple results from two banks, one from the Tier 1 sector and one from Tier 2. I have, of course, Jerry Nnebue from Cardinal Stone, an analyst from Cardinal Stone, here to join me to talk about that. But first, I believe, Jerry, we're going to start off with the markets first. And of course, we're just talking about how oil has affected the markets. How do you see things going forward on the Nigerian Stock Exchange, I guess, for this week? Look into your crystal ball for me. How are you seeing things?
I wish there was a crystal ball, actually, to look into. But really, what we've seen, the news that came out, since the end of last week and then yesterday night, we've seen markets, capital markets around the world react, to the slump in oil prices. And that in itself basically means that you'd see investors leave risky assets into safe haven assets. And of course, the Nigerian equities market is one of the risky assets for foreign investors, even for local investors, as you may know. So we'll probably see some kind of bloodshed in the market.
Bloodshed. You say it so calmly. Bloodshed in the market. But like this floor, as red as the floor is.
Yeah, so it's going to be red, most likely, because investors will just want to react. I mean, a lot of people will react without even thinking. I'm not wanting to be late to the party. So people will react, and then, yeah, it's going to be red. I also expect that's
okay. Now, of course, I mean, that's the negative side, but, every cloud has a silver lining, as they say. What about bargain hunting opportunities for investors? Since, as they say, buy the dip, right? As the market dips, are you advising any of your clients to take advantage of any low stock prices if there is actually a bearish trend this week?
Yeah, so the thing with bargain hunting is that it comes with stocks that have very strong fundamental value. But what we see that is prevalent today is the air or cloud of uncertainty as a result of the coronavirus and then also the ongoing concerns with oil price wars. So right now, there's no clarity, there's a lot of uncertainty. How long is it going to last for? So if you want to bargain hunt, you're asking questions, am I expecting to see a recovery? Because the companies that exist within the macro framework in Nigeria, of course, have a way. They derive to some extent from the implications of oil prices and how it affects the Nigerian economy. So how long is it going to last for? How do you expect companies to perform this year before you even think about bargain hunting? Yeah, prices may be really low, but then are they justifiably low? That's the big question that needs to be asked. So yeah, I think it's going to be an air of caution around, for investors, basically.
That is a very interesting take, because the theme on the market has been, hey, look, stocks are falling, you should take advantage. So you are being cautious and telling folks to just look at stocks with strong fundamentals before, of course, buying anything.
Yes, yeah, that's just it, really. We've seen Zenith Bank, for example, is on offer this morning. So and Zenith Bank is, due to pay dividends, a very solid stock, but then it's on offer because people are cautious, people are worried, people are concerned. Nobody knows, what direction this whole thing is going.
Yeah, so interesting stuff. All right, since we're talking about the markets, we're now going to look, as I said, Tier 1 and Tier 2 bank performances for 2019. We start with Stanbic here. How did you see fiscal year 2019? How did they perform?
Well, the result was okay.
It was okay.
The result was okay. Not a lot of surprises there. I mean, to my mind. Earnings grew, but not so much. Earnings grew, and of course, last year, for Stanbic, what we've seen support their results over time has been a lot of write-backs in terms of loan, loan recoveries. So they've always had that. So where other banks have been reporting impairment charges, so for Stanbic, in the last 2 or 3 years before 2019, they've been reporting a lot of write-backs, and that, in a lot of ways, has supported earnings. But last year, we didn't see that write-back, and so it was largely expected. And so we saw earnings just grew very mildly, about close to 1%.
Right. I'm seeing the profit after tax was just barely 0.8%.
Yeah.
Okay. Yeah. And so going forward for this 2020, you're expecting to see what? The same, pretty much.
Well, not
the same narrative?
Well, not necessarily, because the framework or regulatory framework within which banks operated in 2019 is almost going to be entirely different from what they're going to do in 2020. So we'll see most of the measures, most of them are going to take effect in 2020. The cash withdrawal and deposit charges, with effect in April 1. The reviewing fees and commissions, that banks can actually charge customers are going to take effect, already in effect. So most of the framework that we saw last year, I mean, the yield environment as well, it gets weak, compared to levels we saw at the beginning of last year. So all this would be a bit different from what we saw last year. I'm not really thinking that Stanbic is going to perform as well as it did last year. Although part of the results was largely boosted by trading income, trading gains. Part of the result was boosted by trading gains.
Okay.
And, So, but what's going on right now in the capital markets, coronavirus and oil prices, so there may be some decline, in my mind.
So that means that this profit after tax, I was seeing 0.8. It might actually,
yeah,
it might.
Yeah, we may. I mean, based on, and the thing with banks is that there's a lot of uncertainty, right? Nobody knows what the CBN has up their sleeves. We've seen the CRR measure come into place as well. So nobody knows what CBN has up their sleeves. So yes, with banks, I mean, it's really going to I'm not thinking it's going to be a very fantastic year for banks. For Stanbic, I mean, if you look at the ROE, in 2018 it was 34.5%, and then last year it did 27.3%, and this may likely again go lower than it was. But the good thing about the result was the fact that they were able to grow loans, and they grew loans about 21%. And that was, supportive of earnings performance, and that in itself ties to what the CBN is trying to do.
The LDR, the loan deposit ratio, yes.
All that. So they were able to grow loans, and they were able to take out some of the more expensive deposits in their books. That kind of moderated interest expenses to support overall earnings for the bank.
Okay. So cautious outlook there for Stanbic. All right, let's look at tier two. Let's look at tier one, the tier one space now. Access Bank. How did you see their performance with regards to 2019 and how they did?
Yeah, so Access Bank's 2019 results was I wouldn't say I'm very I wouldn't say I'm very impressed with the results.
Okay.
And I'll tell you why, because as at 9 months, I mean, they had posted very good results, but when the full year numbers came out, and we saw that in Q4 earnings did not really, earnings dipped, so they made about just 7 billion in earnings in Q4, which was not really fantastic. And a lot of that speaks to huge FX losses that were reported by the bank.
Okay.
Yes, FX losses in excess of 89 billion in Q4 alone.
Wow.
Reported by the bank. So that kind of, took, the energy from, the earnings momentum that they've posted over time. But other than that, other metrics were really good. Interest income was good, supported by loan growth. So for Access Bank, we also need to look at the impact of the merger that they had with Diamond at the beginning of the year.
So that's still playing out.
So that plays out across, most of the revenue line items. Interest income was good, net interest income was good. Cost of funds moderated, from about 5.5% in 2018 to about 5% in 2019. They were able to grow loans as well.
Right.
Despite the fact that they grew loans, we didn't see NPLs weaken significantly like we would have expected. If you look at 2018 Access Bank alone, NPL ratio was about 2.5%. But following the merger with Diamond Bank, that increased about 10%. And at the beginning of the year, the bank said they were really going to focus on dealing or resolving those asset quality issues at the beginning of the year. And I think they did well in that regard. From 10%, it closed the year at 6%, which we think is positive. Cost to income, 65.2%.
So that's still,
of course,
that's high.
Yeah, well, that's as a result of the merger, because when it's a business combination, there will be one-off integration costs, and all that. So that's in itself pushed cost and income ratio for the bank. Yeah, so I just think growth in loans. So I think we'll gradually begin to see the benefits, the synergies that come as a result of the business combination. You see from 2021, when lots of the hits in the system has probably subsided.
Has cooled down.
Yeah.
I've noticed a trend with most of the results we've seen, UBA, Zenith, GTB, Access, non-interest income up, the electronic banking, it seems like are they going to be relying more on electronic banking going forward?
Yeah, I think that's one big strategy for banks going forward. If you look at the last couple of years, banks were not really great at growing loans, but we saw a lot of investments in the retail space, in terms of technological infrastructure, just to be able to penetrate the retail space. And with the advent, of fintech and the PSBs are likely to come on board, banks want to make sure that they're still very relevant in the economy. There's still a very huge market out there for financial inclusion when you talk about the rural areas. So yes, and then the potential for disruption also in the banking space. So you think that banks would want to stay relevant, and then they will continue to want to rely on fees and commission as a major support for earnings. If you look at it, really, loan growth, it's not that fertile. The economy is not that fertile to be able to stimulate aggressive growth in loans, which ordinarily should be the core focus of
the bank. Right.
Yes, and then so banks have to look for other avenues to be able to survive, and that's why we're seeing fees and commission be a major contributor for banks' performances. For most of the banks that have released the results, we're seeing near double and more than double increase in
massive growth in that sector, on that line item. Yeah,
and that is good. That is good in itself. What that also speaks to is how the recent review of fees and commission will have implications on banks' performances going forward. What I think can happen would be that, so for banks that have huge retail exposures, they would want to rely on volumes to drive transactions, and then, with the lower fees and commission but higher volumes, you'll be able to break even compared to what you did last year.
Cool. Now, final question here, just less than a minute to go. Exposure to the oil and gas sector, with what we've seen with oil prices, are you worried? Very quickly, in just about 30 seconds, if you can.
Yeah, I should be worried. I mean, and banks also should be worried because some of the banks that we speak to, when we ask them at what oil price they use in benchmarking, loans to the oil and gas sector, some of them say $40 per barrel, $45 per barrel. As at the time when oil prices were 60, 65. Yeah, a bit of cautiousness on their part, but then again, now oil prices are 30, 35, and nobody knows how long. So I think, yes, banks would be a bit worried. They should really be worried in that particular, given the issues that we saw, in 2015, 2016.
Interesting year. Yeah. Jerry Nnebue of Cardinal Stone, Analyst, thank you.